For most of this cycle, people have been asking the wrong question. They've been asking why US consumption is still strong. The real question is how. The latest personal income and outlays data gives us the answer. And it's not comforting. Spending is holding up. Income growth is cooling. Inflation is easing. But the personal saving rate has fallen to about 3.5%, one of the lowest levels of the past 2 decades. That number matters more than any inflation print. Because at this level, savings are no longer a buffer. They're a countdown clock, and that average hides a critical split. For higher income households with assets, savings still exist. For the bottom 60%, they're largely gone. So while consumption looks strong in aggregate, it's increasingly concentrated. The economy is being carried by asset holders, not wage earners. Historically, when the saving rate falls below 4%, households stop smoothing shocks. They don't adjust gradually. They become exposed. And that's exactly what we're seeing now. Consumers are maintaining their spending habits even as income growth slows. Not because they feel secure, but because adjustment feels worse than delay. This is not confidence, it's habit preservation. You can see it in the details. Real spending accelerated in October and November. Goods spending rebounded sharply, especially in durable, tariff-exposed categories. That's not organic demand, that's pull-forward behavior. Households are buying now because they expect conditions to worsen later. Higher prices, tighter credit, less flexibility. And here's the structural shift that matters. At a 3.5% saving rate, consumption can no longer be funded by income or cash buffers. So it gets funded by something else: wealth. When savings are gone, perceived wealth replaces income as the stabilizer. Housing equity, equity markets, retirement portfolios. Not because people are selling assets to spend, but because rising asset values suppress the need to save. The portfolio has become the new emergency fund. That's why asset inflation now sits at the center of this economy. It props up confidence. It delays adjustment. It keeps consumption alive even when cash flow is tight. This is why the economy feels strangely resilient. Inflation is cooling, but life doesn't feel easier. Income growth is slowing, but spending continues. Savings are depleted, yet demand hasn't collapsed. Because the economy is no longer income-driven. It's asset-dependent. Asset inflation has replaced savings as the shock absorber. And that creates fragility. When asset prices rise, consumption holds. When asset prices flatten, spending stalls. When asset prices fall, spending doesn't slow, it snaps. With savings already near cycle lows for most households, there is no second buffer. That's why policymakers react so aggressively to market stress. That's why equity drawdowns matter more than ever. That's why housing corrections carry outsized risk. Markets are no longer just reflecting the economy, they are supporting it. So when you see strong consumption today, don't read it as strength. Read it as dependence. The US consumer hasn't broken yet, but at a 3.5% saving rate, the economy is running on asset inflation, not income growth. And that means the next slowdown won't start in spending data. It will start in markets. This is Global Notes by JP. If you want to understand where the economy is going, not where it's been, you're in the right place. Comment if you think asset markets can keep carrying consumption. Share this with someone still watching inflation prints instead of balance sheets. And hit the bell, because when markets turn, the data always follows. We're building the strongest macro community on the platform, one signal at a time, together.